and it seems like the sell-off is easing and risk may be returning to the table. How have you reconciled what's been playing out in markets from an AI bubble concern point of view to the health of the US economy?
The points that you mentioned, they are very valid. And many investors have been thinking how to play those particular critical events, i.e. the AI bubble. And number two is, of course, the US government's shutdown and its implications on the US economy and the Federal Reserve's decisions following that one. So here is what we think. If you think in short term, of course, your valuations are rich. There is no doubt about that one. But if you look at the fundamentals,
yes,
let's even talk about NVIDIA, and let's even talk about the recent visit, which will materialize everything what I'm about to say. The recent visit from MBS, Mohammed bin Salman, from the Crown Prince of Saudi Arabia to the United States, and the deals and the conversations which were talked about around tech, around AI chips, around the advanced AI chips access. So for me, that is a clear sign. What is that sign? The sign is that there's a huge amount of interest, there's a huge amount of demand from countries who wants to be on the forefront of in this AI play. So if they wanted to position themselves as a leader of the data centers, as the computing power and the chip power, then they need these particular chips, whether that chip is coming from Google, whether that chip is coming from either from NVIDIA, AMD, or from any other competitor within that particular space. So you look at the valuation as of now, you will say that, yeah, the valuations are overblown. The prices are trading X amount their earnings or the book to earnings value and all of that. But if the fundamentals are growing because this is a new industry where we do not understand fully right now the potential and the huge amount of a momentum that it is going to bring and it is going to shift the dynamics, then that is a very different narrative. So in short, what I am saying is that in the short term, yes, the valuations may look rich. And then, yes, the currencies and the events that we've experienced during October represents a great opportunity for an investor to step in who've been sitting on the sideline to buy something at a discount, whether that is a 10%, whether that is a 20% or a 5%. You got the opportunity, you had the opportunity to buy it at a discount because your view is that the industry is strong. So if the industry is strong, it is going to go up. The second important point is, of course, how this particular delay in the data is going to influence everything that we are experiencing, and especially the fact that the prints that we are receiving in terms of the economic data, they are not painting a rosy picture for an investor. So investor is clearly like wondering that, okay, the current print is bad, and how bad it is going to become in the coming days, and what is going to happen in terms of the risk appetite, not from their own perspective, but from the institutional perspective. So this is what we will say. What we will say to those investors who are very concerned about those particular ones is, look at the overall space. The overall space says that trade tariffs, those trade tensions, they are behind us now. Trump administration, whatever they were going to do in relation to scare other countries, I think they are mending those particular relationships. So on the geopolitical front, we are looking at things a lot more better. Thanksgiving is coming, which means that the war between Russia and Ukraine is going to be over. That is another massive tailwind, which is not factored in by a larger extent in the market. Number three is, of course, if the data becomes worse, it is only going to put more pressure on the Federal Reserve to cut interest rate more aggressively. Number four, Jerome Powell's days in the office are very much limited. The next particular president and the chairman of the Federal Reserve is going to be handpicked, in other words, going to be handpicked by Donald Trump. So i.e. the monetary policy direction is going to be in favor of what money loves, and that is dovish monetary policy stand. Because if we have learned anything about these particular markets and from the previous crisis is the market and the market participants love cheap money. They love dovish monetary policy. And with these four particular factors that I've explained, I think that any any sort of a retracement in the market represents an opportunity for you to buy. We are already up humongously for this particular year in terms of these particular indices. Let there be a correction. We wanted to see that correction. I mean, like, I personally would love to see 20% correction in the market so that I can deploy the capital, which will allow my risk management policies to deploy that. Because for me, I have a very strict risk management policies.
Yes.
Market drops 10%, I will deploy this much. Market drops more, then we deploy more.
All right, I just have to interrupt you there so we can move on before we run out of time. Here at home, we have private sector credit due. Now, with credit, or rather corporate credit growth accelerating while household lending remains subdued, what does this divergence signal, I guess, about the underlying health of the local economy? Yes, we do know that sentiment is shifting, but there is concerns around whether we are seeing that change on the ground.
But look, the consumer credit is a very, very important indicator for investors. We specifically don't necessarily specialize in the South African markets, but from an experience dealing with the emerging markets, what we could certainly say is that if consumer credit is increasing under lower interest rate environment, that is healthy because public and then the creditors can still feel comfortable about the balance sheet that they are holding in terms of those ones. But if it is expanding under a hawkish monetary policy stance, which we don't see that happening because everyone is following the same central bank's rules around the world, and with ECB very much on the forefront of that one. And then where I am based, the Bank of England is far behind. And hence you can see the stagnant growth in this particular part among the developed countries. Now, speaking of South Africa, you know, we would say that if interest rates, which we do see that going down and then going lower, so if consumer credit doesn't really represent a huge amount of a concern for me, I would in fact be very bullish going into 2026 for emerging markets. And I would certainly look to invest in emerging markets because of the lack of distribution of wealth that we have seen over the past number of years. So South Africa, for me, remains a very important market.
Are you just as bullish on the UK? We have Rachel Reeves, of course, out with the budget come Thursday, and we all know the troubles surrounding the UK economy and UK finances at the moment. Just quickly there, we have about 40 seconds.
No, I am absolutely not bullish on the UK's economy. I think the government, the politicians, the policymakers driven the country into a completely different, wrong direction. And the upcoming party does not have solid grounds to drive us out of this particular mess that we are in. So we can only hope and pray.
All right, let's leave it there. Thanks so much for your time and sharing your insights with us today.